Welcome to a new video. My name is Robin, and as per usual, I'm joined by Ronald McDonald's. And today we're gonna discuss. No, of course, I'm joined by Kirill, but today we're gonna discuss McDonald's.
Cheeseburgers.
So we're gonna, of course, you're gonna get four of our pillars with you today, which is what's in the news, what are the fundamentals of McDonald's, what are the important ratios, and finally, the value that you're gonna get. What's the valuation? Of course, do your own due diligence, but this is your starting point for looking into McDonald's yourself. So first, Kirill, what's in the news with McDonald's?
Yeah, that's probably, as you said, like before we started filming it. Yeah, September is not so big on the news, let's say, apart from some earnings releases and when everything is going tits up. But the funny part was, and the reason why we picked it up is that the soon upcoming one of the president-elects, Kamala Harris, was saying that she worked at McDonald's for years and she was using it during campaigns and everything. And then Trump was actually trying to defraud this and saying that was fake news and everything. So it's like full scale war going on between the two because it's election period, and it's like, the fun times are ahead of us, especially like when there's going to be a debate upcoming soon. So probably also looking forward to it. And then Robin,
Yeah,
because of that, you said that, oh yeah, let's check McDonald's because that's quite a good topic
yeah,
to
and it's also
discuss.
pretty fun because it has of course, a connection with the White House, with for example the Clinton, and of course with Trump being big on McDonald's. So yeah, we thought it would be a fun idea to actually check the valuation. I don't think we have done it, and if we did it, it was like a really long time ago.
Mm,
So let's dive into it.
yeah.
So the fundamentals, Kirill, what do we have? We have really good fundamentals.
We
So
actually do, yeah.
we can just really quickly dive into the basic statistics. So we can see the dividend of 6.23%, which is quite good. Dividend yield of 2.1%. Dividend payout ratio of 53. It's all looking really good. PE ratio is 21. We did um, we did
Starbucks.
Starbucks
Yeah.
last week, and there it was also around 21. So if I remember correctly, this is in line with the industry. So
Yeah, I mean
that's
it's a little bit different, let's say, form factors, right? Of course, the Starbucks is more like coffee shops and the McDonald's is restaurants, so a little bit different target audience, but yeah, more or less the idea behind it is more or less the same. So
yeah,
wouldn't
exactly.
wouldn't call it expensive. 20 PE for McDonald's, very established brand, so that's quite nice. Not bad, could be worse.
Yeah, exactly. Yeah, and then we see gross profit margin of 55%, which is insane. Operating margin of 53%, which is insanely good. Of
Yeah.
course, they have been active for a long time, and they're really making things efficient now with less employees and whatnot. So we can go to the foundations underneath Korea, and we see check marks all the way, like a long-term debt covered by free cash flow fivefold, which is really good. 15.75% share buybacks, insane.
Yeah.
Insane. That's
Yeah.
just really good to see. And while they're doing it, they're also growing the dividend. This is starting to look like a company that I really want to invest in. Unlike on first, just looking at these things, I'm getting really excited about this stock,
Yeah.
or at least the company. You see that the average revenue growth is not growing as steady, like 2.2%, but they are really efficient, so that you can see net income growth is, you know, also increasing fivefold compared to the revenue growth, which is good.
Yeah. Yeah, so far it's like a pumped up version of Starbucks as we see, like, from the financials. Yeah. Even though, let's say, the revenue growth is not so good, of course, it's as big as it could get. Like, it's probably Coca-Cola kind of titan of business, of consumer goods. But they're being very efficient and keep on growing that. So that's very good to see. Yeah, I fully agree with you.
Yeah. Right. So just let's move down a bit
Mm-hmm.
and see if there's anything that uh, gets our attention. But it just all looks very,
Yeah.
things you would expect.
Yeah, not that much debt. It's yeah, just well managed. No, nothing flashy. Very stable. Keep on growing the free cash flow per share, which is also very good for you to see as an investor, of course. Not, sky high kind of numbers, but still because of the, operational excellence part of things. That's good. That's very good to see. Yeah. Yeah.
So, and also for the key ratios, so the net earnings ratio above 20% good. Selling and general expense ratio negative.
Well, it's flipped because it's still in our test environment, right? So it's of course it's positive. It's just, sorry guys, it's that's why we're still not launching it. There's still some quirks here and there, so
Alright,
it
but
should
then at
be
least
11%. Yeah,
yeah, below 20%, which is also good. So they don't
yeah,
really need a lot of marketing to push their products. Of course, it's a household name. Everyone knows McDonald's.
yeah,
We can go a bit lower.
yeah. This is also a little bit of a bug, so also don't look at it. But again, shares outstanding. They keep on buying them back, not at very high rates, of course, but before COVID, it was around, let's say, 2.5 or 3.6%. That's nice. That's quite good to see, to be honest.
Yeah. And then, yeah, just all good. The operating profit margin, as we said, yeah, above 30. Really good
Yeah.
gross profit margin, above 40 even. Just a really good company.
Yeah. I think it's going to be also a very quick video from us because, like, it's hard to really explain what McDonald's is because everyone knows it. Only thing is maybe for you guys to just highlight the fact that what's the business model behind McDonald's, right? So it's not that all of the restaurants are managed and owned by McDonald's as a company, right? It's all based on the franchise model. And I think only 5%, like the with the best locations, kind of restaurants of McDonald's are managed by the company itself. The rest, the McDonald's owns the land, and it just gives rights to the franchisees to build the restaurants there and operate them. So they also get the stable, franchise fees, and that's how they also make money out of it. So.
Yep.
And then again, because of the fact that it's a kind of like a subscription based model, you can call it in a way, because you as a franchisee, you must pay the fee all the time, unless you're gonna go bankrupt and then someone else is just gonna take your place because everyone wants to probably have McDonald's, and because the results are quite good. Everyone knows it. Everyone goes to McDonald's, no matter how old or young you are. So. Yeah, it's quite a good deal for everyone, and of course also for McDonald's itself. So,
Yeah. Yeah, exactly. So just all know good business model, and we can see it reflected in their finances. All right. So do you want to go to the valuation?
yeah, I think we can.
All right. So here, we always use the free cash flow starting point as last year, but you can always tweak this to your own likings.
Yeah,
Then for the projected period, I would even say 10, 15 years.
15
It's
easy. Yeah,
such a household name, and food is something that people always need. Food, clothes, shelter, of course, the main, um, basic life needs that people have. So this will just always be a thing. Then we can look into the discount rate. We keep this normally at 10%. And for the estimated growth rate,
I
what
really
do we
want to put
see?
15 for the free cash flow. Can you also check maybe Yahoo Finance in the meantime?
Yes, I'll go there.
Yeah, because to be honest, like if you put in, for example, as an average revenue growth of 2%, of course, then your estimates are going to be quite low and not so bright and shiny. Because I would also in this case rather select the free cash flow growth because of the operational efficiency and how well managed the business is. So instead of like them keep on growing the revenue part of things, they're keep on improving the business because let's put it like that, if as long as revenue is growing at least on par with inflation, that's okay, that's completely fine, there's nothing bad with that. But if the companies keep on improving internally, there's of course they're going to hit the ceiling at some place at certain time, but you can at least project maybe maybe not 16%, maybe 10, let's say, just to get a little bit of margin of safety. Or you can still put 16, but just increase the margin of safety a little bit higher just to account to this uncertainty, for example. Yeah, but what
So
does Yahoo Finance say?
so the analysts think in the next 5 years per year is going to grow at 4.4%.
Yeah, that's
So I
probably
think that's
revenue. Yeah.
exactly. But we can take the average. We can do 10%.
Yeah,
So
yeah. I
1 plus
think
16
that's
divided 2.
yeah, exactly. Yeah. I think that's more or less pretty reasonable because we count both the revenue growth but also free cash flow growth, and I think that's
Exactly.
more fair. Yeah.
And then for the projected PE ratio, so we've seen that for the past 15 years they have had a PE ratio of 27.
Yep.
And the lowest is what it is now, so 21.
I think right now it's
So
21. Yeah.
yeah, so let's put maybe 25-ish,
Yeah,
just around there.
25. Yeah. So it's a little bit cheaper than the average. Yeah, which is also good to catch around this time. So yeah.
All right. And then for the required rate of return, as per usual, if you invest in S&P 500, you would expect a return of around 7 to 10%. But because you're stock picking, you want to have a higher yield because you're taking on a bit more risk. So usually we do either 11, 12% around that number. But of course, if you want to really find those unicorns that's going to make you rich, you can put 300%, whatever you want. It's going to be more difficult for you to find undervalued companies, of course. But yeah, you could try. And then for the margin of safety, I mean, it's a pretty basic business model, but there are some fine details that I am not aware of. For example, how their retail works, not retail, real estate, for example. So like you said, the land that they own. So for me personally, I would put this maybe to 25, 30%, just because I don't know a lot about that part of the business.
Yeah.
But their core business is pretty easy to understand.
Yeah, that's the thing, because I think it would also, let's put it like that, from the business model perspective, right? From the revenue streams, like McDonald's is popular and is well known from all over the world, right? So from having the brand image and it being very popular and well known, that's not a problem at all, right? The only thing is that if the company, what's going to happen, for example, if the real estate is going to go down globally, for example, how is it going to affect the financials, right? Because that's probably part of the income the company is getting, probably from rents or from selling the assets here and there. And then also the question is, okay, right now, so far so good, knock on wood, they can do very well in OPEX, in operational excellence, but for how long will it last as well? Because you cannot, unless you're going to just put robots everywhere, and then they're going to be flipping burgers and stuff, okay, sure, and then make it work 24/7. But then, yeah, how far-fetched that is, that's also another question.
Yeah, so these are the things. So I would, like I said, 25%, so that you can also do some more research on your own. Maybe look into, could this be an assets play where the assets of McDonald's are actually higher than the market, than the capitalization of the company itself, or like of course, valuation. So these things are something that you can keep in mind, even though it's an easy business model. There are certain layers that make it a bit more complicated and interesting. All right, and if you then go down, then we can hit the analyze button and see what the valuation is.
That's interesting, eh? Yeah, it's a little bit on the lower side. So we got the average of 157, right? And with a target buy price of 118. I would say it also really depends on what kind of formulas you look at, right? So for example, the target valuation formula is more or less on par, right? But if you also look at the discount cash flow, intrinsic value formula, or any other ones, there, I would say a little bit lower, on a little bit of a lower side, so does it mean that still McDonald's is quite expensive, even though it's well managed? Could be, because I mean, if you, at the end of the day, if you're paying almost 30% of PE for a company that grows its revenue of 2% annually, that's, I would say, even, to be honest, unjustifiably a lot. That's just too expensive, really. So is it something to potentially add to your portfolio if it's going to go down as some dividend play? Yeah, probably. Another question is, okay, if we get the valuation of 160 and it's traded at 290, are you willing to pay the double of the premium for that? Maybe not. So it's, again, that's a whole beauty of these two, right? So you can at least put your assumptions in, even though Robin was very excited. Honestly, he was very excited about the company before we started making the video. But now when we check the numbers, it's like, okay, it's nice. Yeah. It's nice, but it's expensive. So exactly. Is it worth it?
That's the whole thing. So yeah, and this is also, like you said, Creo, so that you have a system in place, right? So if you are as excited as me at the beginning of the video, and then you get this reality check, and you're like, okay, cool, maybe we should check something else. Keep this on the add this to the watch list. Keep it for later, and then when shit hits the fan, for example, come back to it, see what the valuation is, and then maybe buy it or maybe not.
Yeah.
So with that said, we covered all four of the bases that we want to cover. Kirill, thank you as usual for your great insights. And thank you for watching. And then we'll see you guys in the next video.
What don't women understand about men?
cheeseburgers.